All right, and we are live. Welcome, everyone. I believe we are just getting our attendees joining now that are joining live, so they will be jumping in here in a minute. But we're going to just go start off with a bang here. So my name is Bronson Hill. I'm the CEO of Bronson Equity. We do multifamily investing, helping resale investors to get hedge inflation through multifamily apartments. Joining me today, we've got really an awesome panel. Feel really honored to have friends and just experts here. I'm going to just give a quick intro to them. So we've got Rick Rule is here, George Gammon, and Mark Moss, just some of the leading voices on inflation. So we're going to jump right into it. We're going to have some time for Q&A toward the end. So if you are live or watching on a replay, if you're live, you're going to be able to ask some questions. We're going to just jump right into it. So let's start with George. Welcome, George. And why would you say most people are unprepared for inflation, and why is it something the mainstream is starting to talk about more now?
Well, I think the main thing they're unprepared for is asset price deflation and consumer price inflation. And if we look at the 1970s, that's a great example. From 72 to 74, the stock market actually went down by 50% in nominal terms. So people have this idea that if we're in an inflationary environment, that means that asset prices, such as especially risk assets, have to go up. And that isn't necessarily true. Another thing that I would point their attention to is the yield curve. If you look at the 2s and the 10s, and I'm sure this is something that Rick's paying a lot of attention to right now, the yield curve is actually flattening. And if you look at the Euro-dollar futures curve out to past 2024, it's inverted. And so then if we take Powell at his word that he's going to raise interest rates, let's say 3 to 4 times, if we just think that, okay, Fed funds is going to, let's just say 1%. And then right now, I know the 10-year was down, so I believe it's at 1.75. And if we look back at the last time the yield curve inverted, which was 2019, there was about a 60 basis point spread between the 1 year and the 2 year and Fed funds, roughly, right? So if Fed funds goes to 1%, then we can assume that the 1 year, the 2 year, which is usually the benchmark that they use to juxtapose against the 10-year to see if the curve is inverted, which is a 100% sign that we're going to have a recession. So the 1 year, 2 year, let's say that gets up to 1.6, right? Well, the 10-year right now is at 1.75. So that means that the 10-year would just have to go down another 20 basis points, and we would have another inverted yield curve, which means that there's a extremely high probability that we go into another recession. Now, I don't think people are prepared for an inflationary recession like we had in the 1970s. And again, this is where asset prices go down significantly. We've seen, go back to November 3rd. That's when the Fed announced tapering, which, just to remind all your viewers, that's just when they're doing less QE, right? That's when they're taking their QE program down to zero. They announced it November 3rd, and they started implementing November right around the 15th. So they were doing 120 billion a month in QE, and they dropped that down to, I think, 105, and then they've taken it down since then. But the market is down, I would say, 10 or 15% since they announced the tapering program. Now, they haven't even gotten to the interest rate hikes. They haven't even gotten to quantitative tightening yet, which is actually reducing the size of their balance sheet. So if we look at crypto, if we look at risk assets, and unfortunately right now, Bitcoin and other cryptos are trading as if they are risk assets. I'm not saying they are, especially long term, but right now they're trading that way. If you look at the NASDAQ, if you look at ARK Innovation as an example, they are down massively since the Fed just announced tapering. So again, taking Jerome Powell at his word, if they raise 3-4 times, if they even start quantitative tightening, what does that do to the stock market? And I think it's very easy to see us getting to a 1972 type of environment where the stock market, again, is going down by 50% in nominal terms, but consumer prices are increasing substantially. And then the next question becomes, what does that do to overall purchasing power, right? What was the pain index? I believe that was inflation plus the unemployment rate or something like that. Well, I think they need to get a new pain index with consumer price inflation compared to the rate of the stock market going down, because I believe that our economy today is far more dependent on the stock market than the economy was back in the early 1970s, right?
Yeah.
So again, it's this weird type of economic environment that Keynesians don't think can really exist, because they're looking at the Phillips curve and saying, well, if the unemployment rate is down at 3 or 4%, just forget about labor force participation. Then that means that we should see inflation. And Keynesians, they conflate inflation with economic growth for some reason. I don't know why they do that. They think that inflation means the economy is booming. And as most of us know, that's absolutely not true. That you can have an economic contraction while you see significant consumer price inflation. So I think that's one thing where the market and the retail investor may be offsides. The other area I think is probably housing, because people think that if the housing market goes down, that it has to go down in nominal terms, right? We have to see a GFC as an example. And I always point out that that's when you adjust for inflation, that isn't necessarily true. That we have, if you look at the price to income ratios right now in the United States for housing, they're at all-time highs in a bad way, meaning that it's over 7 times the annual income to buy the average house. And that's higher than it was back in 2006. But so most people think, okay, well, then housing prices have to come back down to get to their historic trend adjusted for inflation. And that's, again, not true. You could have an environment where wages are going up by 5%, but they're lagging CPI, especially real CPI. And let's say that's at 10%. So people's purchasing power is decreasing. But then let's say housing prices are only going up at 7%. So the unaffordability is increasing, but yet the housing prices in real terms, as far as purchasing power, is actually going down. And when you look at the stock market going down, potentially with people's equity decreasing in real terms, that's when we could further see this inflationary recession. So that's not really a prediction, but I think that's something that not a lot of people are looking at, and I think they should be thinking that through.
George, thank you. You covered so much there. I know for a lot of people, it may go over their heads a little bit, but just it's clear that you believe there's a recession coming, and it's going to look different. It could more look like a 1970s event rather than just simply, some sort of crash. I'm going to let each of you. So why don't we start with Rick, and then we'll go to Mark. There was a lot there. What do you want to? Do you agree? Do you disagree? Are the things that what would you say is kind of where we're at right now and where we're headed?
Well, there was a lot there, and George said it better than I could have, but I'll try and add on to what he said. With regards to recession, I have to say, between Doug Casey and myself, we have completely accurately predicted 17 of the last 3 recessions. So I'm just going to disqualify myself on that.
Peter Schiff as well, right? Peter Schiff has done that
too. He's a Peter come lately to that. The other comments, though, I think are worthwhile, and particularly the idea of the delayed impact of inflation statistics on people's psyches. Unlike the rest of you, I was here for that 1970s event, and mostly cognizant. I was very young at the beginning, but I'm reminded that in the period 1967 to 1972, 1973, the real inflation numbers were high. Interest rates, then price controlled on savings products, were low. In other words, the circumstance that Americans faced at that point in time was eerily similar to the circumstances that they face today. And the response of the savings and investment public was similarly somnolescent. We had been conditioned through epically good conditions through the 50s and the 60s, good economic conditions, to expect that things would only get better in the United States. And the consequence of that was, despite the fact that simultaneously we fought the war in Vietnam and the war on poverty, lost both, of course, and had a fiscal hangover around both of those, expectations and actions of investors and consumers didn't change in the face of facts for a very long time. When people ask me now, Rick, how come people aren't acting in traditional ways around inflation, even in the face of both negative real interest rates and inflation, I think that we've been taught in the last 40 years, which were very benign, to believe that the Fed had our backs, to believe that government had our best interests at hand, to believe that you buy the dips. I mean, hell, we've had a 40-year bond bull market. What could be better than a 40-year bond bull market? What could be better than the cost of capital, at least as measured by the U.S. 10-year Treasury, falling from 15.6 to 1.5 or 1.6? The point is that if you are conditioned by falling interest rates and you count on interest rates going sub-zero for any extended period of time, you're in for a really rude awakening. My belief. The idea that people are sanguine about the concept of negative real interest rates means that they are comfortable with a very unnatural situation. That's as though George saved and invested and scrimped and got lucky and everything, decided to forego consumption, and lent his money to me so that I could consume immediately, and paid me for the privilege of him taking on my credit risk on my consuming while he saved. This is not a natural set of circumstances, but the incongruity of it is lost on people because the last 40 years that they've been through is so benign. My suspicion is that 40 years is over and a different 40 years is starting. I'm not one of those who says it's going to be all doom and gloom. I certainly at least hope for me that I'll stick handle my way through it. But I think the circumstances, the fact that the circumstances are demonstrably changing means that investors' responses and savers' responses must change too.
Yeah, no, appreciate that. And Mark, I know you were just sharing before about how you study market cycles as well. And so let's hear, like, what do you think, where we're at, where are we at, where are we headed?
Well, I think where Rick ended it is kind of a perfect segue, right? I mean, the market is definitely different. And so he kind of started going back into the 1970s and, things were a lot different in the 1970s. People weren't as invested in the stock market back in the 70s. And so George was making a good point, which is like people probably aren't prepared for the stock market crashing and maybe consumer prices going up at the same time. And so today we're seeing in a different situation where people have a lot of their wealth in the stock market today, have a lot of their wealth in the homes. And so that was a lot different in the 70s. And then, we talk about, is it going into a recession? Well, how good is the economy doing right now? Right. Sure. Biden says that unemployment's at 3.5%. But if we go back to how it was calculated just 20 years ago, we're at about 25% unemployment. It's no wonder that we see help wanted signs everywhere when supposedly we have, record low unemployment right now. And so I would say that we're in a recession, the economy is doing bad. And I think, we saw, especially in March 2020, the market and the economy got disconnected. And so, it's really hard for people to think through this and navigate what's going on exactly. Measuring inflation with a single number, for example, is a problem. And so the other thing is that it's pretty ridiculous we're at this point in time. And I know things have been this way, but it's definitely gotten worse where George said, can we take them at their word? Or if we do take them at their word, we have 4 rate increases for 100 bips coming or whatever. But it's like, we're all trying to guess what these people might do, what's in their head. And so we're all kind of victims of that. But I would say I probably would agree with George. I think there's a deflation in asset prices coming, inflation in consumer prices coming. I think they're going to probably postpone it, would be my guess, another 18 to 24 months. But again, we're guessing what's in their head and we'll have to wait and see.
Right. It's really interesting. We talked about, how the Fed has said they're going to raise rates. We take them at their word. A lot of people think, a lot of this asset, the asset prices being so high is really induced by the Fed, by their low interest rate for an extended period of time. But what do you see before we get into it? And this is kind of the second half is going to be more on what people should consider doing in regards to all this. But what do you see the next 12 to 24 months looking like? Is it going to be kind of like what George said, where it's like, hey, maybe they'll raise rates and maybe they'll come back? I maybe didn't say that, George. Maybe I've heard you say that before, but are they going to be able to follow through on this, or is it going to be something they're just going to continue to push down the road, or they're going to, there'll be a tantrum and then they'll kind of come back into it? Maybe we'll start with Rick on that one.
The first question is, I don't know. Honestly, I don't know. When I was younger, I thought shorter term. It's odd that now that I have less time on Earth, I think in longer time frames. But my life has told me the fact that I would prefer to understand what was going to happen in the short term doesn't matter much because I can't. I would caution all of us to understand that in the near term, confidence, which is what holds things together, is weight in narrative, not an arithmetic. And if you pay attention to the arithmetic, you tend to underestimate the length of time that it takes for people's behavior to change. Recency bias is a very, very reasonable, very, very powerful thing. People's expectation of the past is set by the future, is set by their experience in the immediate past. If you look as an example around the arithmetic concerning the U.S. 10-year Treasury, that is to say, you lend money to the U.S. government irrespective of what you think of their credit quality, and they pay you 1.7% in a currency that they acknowledge is depreciating in terms of purchasing power by 6.5% compounded. Simple arithmetic, 1.7 minus 6.5. Not a real good deal. My friend Jim Grant calls it return-free risk. And yet billions and billions and billions of dollars are committed to return-free risk. A situation that's illogical like that can go on until it doesn't. And when people ask me what I think is going to happen in 2022, I sort of say, why do you care? What you need to concern yourself is what's going to happen over reasonable periods of time. And I've, further to that, sorry for all these old man's homilies.
We like it.
But, one of the things that I like to do is concentrate on actions and things like that, where the answer necessarily begins with when, not if. When people ask me to peer into the minds of the big thinkers, despite the fact that that's tempting, preferably with a pickaxe or a shovel or something like that. But I know I can't do it. And so if they ask me, will things change? Will confidence change? Will confidence break in 2022 or 2023? I have to say, I don't know. But I can say with a very high degree of confidence that there will come a time when people are no longer willing to receive 1.7% interest rate in a currency that's losing 6.5% a year. I mean, I get that. The answer to the question then is a when question, not an if question. And I'm very comfortable with when questions. Let's say that I got out of the way of that equation 2 years too early. And let's say that I deprived myself of 1.7% in the U.S. 10-year Treasury, even in favor of 25 basis points in cash. But I saved myself the readjustment in bond principal when the interest rate changes that chopped 30 or 35% off my bond price. I'm actually pretty happy with that trade. So my own circumstance is that you can't tell what's going to happen in a year. You can't tell what's going to happen in 2 years. However fascinating that topic might be to you, what you're doing is trying to know the unknowable. What you need to do is pay attention to the inevitable. It may not be imminent. And you need to prepare yourself as best you can for an uncertain world where the outcomes are probably less benign than they have been for the last 40 years. Sorry for that generalization, but I just answered the question.
Appreciate the wisdom. No, you have obviously a lot of experience, and I like that. So really focusing on more longer term goals and what is inevitable, and not necessarily the timing at which that will happen. I think that's great. Mark or George, do you guys have anything to add as far as the next year or two here?
Yeah, I mean, I can speculate, and I'll give 17 guesses and try to get 3 right, kind of like Rick and Doug Casey. That's about as best as I can do because my crystal ball hasn't been working lately. But one thing that Rick had said a couple of times before we started recording, and just now he was saying as well, is he kept using the word confidence. And that's a super important word because everything that we have is built off of trust or confidence, right? We have to trust that the government is going to do what they say. We have to trust that our money is going to be, worth something. We have to trust and have confidence in all these things. And we're seeing that deteriorate at a rapid scale, a very, very rapid scale. Ludwig von Mises warned about the crack up boom. And suddenly he said the people realize that inflation is persistent and on purpose. And they wake up and they won't use the money anymore. So that's what he called it. And so we're seeing this trust in all the institutions breaking down super fast. Mainstream media is trying to hang on to these narratives, but they're being broken left and right. They can't control that narrative anymore. The more they try to censor, the more trust is being broken, the more confidence. And so that's something to keep an eye on. Again, going back to my non-existent crystal ball, what I think is probably more likely to happen is that I think we see a lot of jawboning from the Fed. They're going to say they're doing things. As George said, they told us in November they were going to start doing it. They haven't even really done anything yet, and the market's already selling off. And so the markets really move based off of what they say. So they can do a lot of talking without not a lot of action. They can pivot back and forth a little bit on that and try to get the movement out of the market that they need. That's kind of my guess. I think what we see is we have so much debt. We surpassed 30 trillion now for the first time, which is pretty amazing. We've doubled it from 10 trillion or from 20 trillion to 30 trillion just since 2017. And now that it's gotten so big, it moves very rapidly. So rapid swings, lots of volatility that we'll see there. And so I think that's what we expect to see over the next year and a half. They're going to continue to try to tamp inflation down while they continue to stimulate the markets. I think we're going to see more price fixing coming into play to try to control that price increase narrative, as well as we're going to continue to see the CPI basket be reshuffled as well. So I think we'll see the CPI and the employment numbers reshuffled. So it shows a little bit different, some price fixing coming into the market. Be aware of, especially in the real estate market in California specifically, lots of talk with, rent increases, things like that. While they continue to manipulate the market based off of what they're saying and still trying to stimulate on the back end. And I think we have about another 2 years of that before something big happens in my non-existent crystal ball.
Yeah. And Mark, you're talking about rent controls in California?
Well, and rent controls in California. So I know one of the questions we'll get to later is about the CPI basket. And if you look at, rents over the last year, they're up, nationwide average about 20%, a lot higher in certain markets, 60% in some. But in California, you can only raise them 5% a year, right? In certain markets. And so, yeah, things like that.
Yeah, and I actually live in Pasadena, California. I just got a notice saying they're trying to do a citywide thing saying you can only raise it 2 to 3%. And so they have this, as well as there's some sort of eviction moratorium. They want to just kind of do this local stuff as well. So it was interesting that I've heard George talk about that as well. But George, give us some of your thoughts on all this.
Well, I think that it goes back to the stock market as far as what the Fed is going to do and what the government is going to do. I think if the stock market goes down by 20% over the next 18 months, they're fine with that. I don't think that's really going to cause them to take any action. I think they'll still maintain their course. And the main reason I say that is because there's several things that are political kryptonite, if you will. But I don't think anything is as detrimental politically as consumer price inflation, especially that the average Joe and Jane can see daily. The price of beef going from, I don't know what it's gone from exactly, but let's just say from $5 to $10. The price of gas going from $3 to $4, the price of rent, to Mark's point, college tuition, childcare, daycare, insurance, etc. This is what the average person really notices. So when they see significant inflation combined with the media talking about it over and over and over and over again, then I think the administration and the Democrats, the midterms, they look at this and say, okay, we've got to do something ASAP, or there is zero probability that we get reelected. So when Jerome Powell is increasing rates, let's say, they see that as a way to combat inflation, to show the general public that they're, quote unquote, doing something. And so, again, if you got this gradual churn down in an orderly fashion, as the Fed would call it, that you'll continue to see these rate increases, where if we were in a disinflationary environment, say, and again, as measured by the CPI, and I know it's totally bogus, but if we were in a disinflationary environment, such as, let's just say, 2010, 2012, they would be much more ready to backpedal and turn into and having a more dovish stance, right? But I think that, you can imagine what would happen if Jerome Powell kind of balked on raising rates in March. And, because the stock market was down 10 or 15%, I think you get a phone call from Biden or whomever in the administration, whoever is really pulling the strings, saying, hey, listen, no, you cannot reverse course. You can't go back to 120 billion of QE per month. You can't take rates, assuming they were up, you can't take them back down to zero. You just can't become more loose, because this is going to exacerbate inflation. And even if it doesn't, it's going to in the psyche of the voter. And so I think that would hold a big impact. Now, if the stock market goes down by 20% in 2 weeks, that's a different ballgame. that's a much different phone conversation between Biden and Jerome Powell, because then he comes back and says, okay, I'll lay off I'll maintain my hawkish stance, but you got to realize that the stock market is going to continue to go down most likely, and the economy is directly tied to the stock market. So which do you choose? Do you choose inflation, or do you choose the stock market, potentially the economy collapsing and going into recession? And then I think Biden says, well, hold on, let me ask the people around me.
Yeah.
And they say, well, how can we do both here? What's the path of least resistance? And I think that goes back to what Mark was saying with price controls. I think that's an easy out for them. And I've seen this in the media. On my Rebel Capitalist channel, I do 2 or 3 videos a day on kind of the news and what's going on. So I've kind of got my finger on the pulse of what how the narrative is changing with the media. And I've seen them come out with a lot of stories that are actually favorable to price controls.
Yeah.
And of course, they ignore the 1970s because they can't go down that path. But they start referencing the 1940s as though the price controls back then were somehow good. And we did it the right way in the 1940s, but we did it the wrong way in the 1970s. So if we just do it the right way again, then this will be the solution to all of our problems. So then Biden can say, okay, Jerome Powell, you go ahead and take a dovish stance. Let's get stocks back up. Let's fix the economy. We might even come out with another CARES package 2.0, basically more deficit spending that's monetized by the Fed. But then he comes out and says, guys, don't worry about the inflation, because this inflation hasn't been caused by money printing. It hasn't been caused by economic distortions created by the government, by the way, in the response to COVID. No. The only reason that prices are going up at the grocery store is because these greedy capitalists, they're taking advantage of the situation. These greedy business owners. And therefore, I'm going to stick up for the little guy, and we are going to take bold, aggressive action in the form of price controls. We're not going to let the man stick it to you any longer. And I mean, you can see them with this sales pitch. So I think that the more disorderly the stock market goes down, assuming that it does go down, the higher the probability that you see something like this. But again, if the stock market goes down by 20% in an orderly fashion, let's just say over the next 18 months with a little bit of volatility, then I think the Fed just kind of stays course, and it's just kind of a bear market. I think that's how the Fed is hoping to squash inflation without positive real rates. Because I mean, this goes back to what Rick was saying earlier. And most people don't realize that we have unbelievable negative real yields. I mean, unbelievable. And you go back to the 1970s, and they actually tried to increase interest rates several times at the beginning and the middle of the 1970s before Volcker came in and brought rates so high that it finally broke the back of inflation. But he had to have positive interest real rates to the tune of like 6 or 7%. In order for us to have positive real rates today of 7%, Fed funds would have to be at 14%. So how the hell are you going to do that? There's absolutely no chance. So I think in the Fed's mind, they see this. They know that it's impossible for them to have positive real rates. So maybe if they can just kind of have this soft landing, or stick the landing, if you will, and just bring asset prices down enough in an orderly fashion to have the CPI cool off a little bit. And then to Mark's point, you change the basket. So the headline number seems like it's going down. The politicians can claim that they're doing something. I think that's the best case scenario for the central planners, which include the central bankers and the politicians. But again, it goes back to how this market goes down, assuming that it does.
Yeah, that's wow, a lot there. We're going to shift gears here in a second, just to kind of okay, so now we know this. What do we do about it? What are people here saying? What choices do I make? Obviously, we're not giving anybody any specific investment advice, and consult your professional or use common sense. But I wanted to actually ask Mark, talk to us a little bit about cryptocurrency, central bank digital currency, potentially. How do those two interact? I know you invest in crypto. Can you talk to us just kind of about that, the asset class and kind of what you see there, and benefits and maybe some risks there as well?
Yeah, well, George talked about it briefly before, and I think he got it right. I mean, it's kind of moving like it's definitely moving like a risk asset at this point, right? We've seen it sell off back to that kind of November date where it peaked out with the rest of the market, and so we got it kind of moving like that. I think one thing we have to kind of keep in mind though is that in a liquidity event, everything goes down. And today the market's more connected than it's ever been before. And so if we go back and look at gold back in 2008, when the whole market sold off, the market sold off over 50%, almost 60%, the stocks, gold also sold off, right? 25%. It's what came after that mattered, right? So gold rebounded pretty quickly, reclaimed its all-time high in about 7 months, and then went on to make amazing new highs from like a low of 680 up to almost 2000, whereas it took stocks 7 years to reclaim its previous high. And so in March 2020, we saw Bitcoin was on the scene now. So Bitcoin and gold also sold off with stocks as well. But Bitcoin rebounded from a low of 3,800 up to almost 70,000. And so in a liquidity event, everything sells off and we're more connected than ever before. I like to say Bitcoin, not crypto. So we have Bitcoin over here. We have all the rest of cryptocurrencies. I think mostly cryptocurrencies are super, super, super highly speculative. It's like playing penny stocks. I think most people that play penny stocks like it for fun. It's exciting. They don't think any of those stocks will ever hit the NYSE exchange. And I think the same about most cryptocurrencies. Bitcoin has obviously reached institutional level, not only institutional, but also sovereign level at this point, right? With El Salvador making it legal tender and whatnot. And so I think Rick was saying it's not the if, it's like the wins. And so a win, like what time frame are you looking at? And if you're looking in the short term, Bitcoin and cryptocurrencies, highly volatile, highly speculative. I think if you can look over a longer time period, 5 years out, 10 years out, for me, I think Bitcoin is still a very good investment. I think it's the best risk-adjusted investment over the long term that you can make today. But like I said, separating those from cryptocurrencies and also, like I said, agreeing with George, it's definitely trading like a risk asset right now. It's starting to pump back up. It dropped like the stock market. It's going back up with the stock market as well. That's what I would continue to see. I think I'd mentioned earlier, I think maybe we kind of see this market cycle play out for the next 18 to 24 months. And the reason why I said that is the second part of the question you asked me, Bronson, which is about the central bank digital currencies. And so this is a bigger subject that I'm going to talk about super brief here, but I know George has done a bunch of videos on this as well. And the world leaders, whatever we want to call them, I've stopped using the word elite anymore. They're not elite at anything. I wouldn't hire any of them to do anything for me. They're elite at running in politics, but these world leaders, they're funneling us into a situation where they're using a word called freedom as a service. And so as long as we do what they say, then we can gain access back to freedom. And so it requires us having a passport, something to gain access to society. One of these big failures that they've admitted that that central planners causes central planners to fail is a lack of data, lack of input. And so there's a push to get us to digital ID, central bank digital currencies, to your question, freedom passports, whatever you want to call it, being careful on the language here. And I think if you look at a financial game, the financial system is ready to be reset. 80 years ago, they reset it with the Bretton Woods Agreement. The IMF is calling for a Bretton Woods 2 moment. That's their words. When you're playing a game, there's no more moves. You have to reset the game. When interest rates are at zero or negative in most parts of the world, and we printed $20 trillion in debt in 24 months, or really more than that. And George, as George said, trying to get those back to real rates or positive rates, it's impossible. So you have to reset the game. They're calling for it. And so a lot of times we talk about, do they want to save the market? Can they prop the market back up? But that assumes they want to. And it was actually maybe Lynette Zhang was the first person that kind of put this on my radar, but she said, maybe they only want to keep it going until they're ready to make the switch. And that's when I started thinking about it. And so if they want to get us in central bank digital currencies, which we know they do, China's already rolled theirs out. The Fed opened theirs up for guidance, I think 2 weeks ago, opened it up for comments. I think it's about a 12 to 24 months before it's ready to go. And so I think, cryptocurrency is a place that I'm going to escape that. That's my life raft. But I think the central bank digital currencies are coming 12 to 24 months. I hate to say it, but again, in my crystal ball I don't have, tells me that we could have some extreme event, potentially a cyber pandemic that happens. They've already ran the test for that. It's an attack on the financial system, goes into a bank holiday, and they open it back up with central bank digital currencies. That's kind of what I'm seeing.
Yeah, interesting. So you're a fan of Bitcoin. We do real estate, multifamily real estate. We had a deal. We're just seeing crazy valuations now. We bought a deal in Jacksonville, 288 unit in Jacksonville, 27 million last March, and we just sold it in December for 37.5 million. And so we rolled it. We almost doubled the investor equity, which is always obviously a win, but you get to use debt to buy some of these assets, which is great. Rick, talk to us about metals and alternative. We call them alternative assets. I just call them real assets. But what are some things people should consider looking at? I know you mentioned uranium, I think, on our last panel. Can you talk maybe some of the alternatives out there and some of the things that you like today?
Sure. I mean, traditionally, the precious metals markets have done very well during periods of time when people are concerned about the maintenance of purchasing power in traditional fiat-denominated investments. As we mentioned earlier, in the decade of the 1970s, the biggest bull market in precious metals of my career, there was a 5-year delay from the time when the need for change was apparent and the change that, the change in people's attitudes. If past is prologue, and I suspect it is, we're going to have a very, very, very good precious metals bull market. Will it happen in 2022? I have no earthly idea. What I can tell you is that precious metals bull markets are of much longer duration than most people think. People have said to me, Rick, this bull market in precious metals, I mean, it's stalled now, but it's been underway for 3 years. Did I miss the boat? I don't know. The first one of my career was 11 years. The second one of my career from 2000 to 2011 was also 11 years. So I suspect that 3 years is short of tooth and that this one has 5, 6, 7 years to go. Dimension too. People say, well, Rick, the gold price has already gone from 1,000 to 1,800. Have I missed the boat? Well, let's go back to history again. First one, $35 an ounce to 850. Admittedly, the 35 was price controlled. But the second one might have been more illustrative, $253 an ounce to $1,900 an ounce. If you have a circumstance where people's faith in debt instruments is challenged, consider the fact that institutional investors worldwide have been in a mantra where 60% of their assets are in equities and 40% are in debt. If you're a long-term investor, pension fund, insurance company, university endowment, and you come to the not so stunning realization that 40% of your portfolio is costing you money every year, your ability to provide for pensioners 20 years from now, your ability to make whole life insurance policies 20 years from now, your ability to run Stanford University 20 years from now is being called into question because 40% of your portfolio is yielding you a guaranteed loss. You need to be able to reallocate some of that portfolio. If you come to be afraid of inflation, which I suspect you would be if you're getting 4.7% yields on junk bonds and your purchasing power is declining by 6.5%, and you look for alternatives, one alternative that you might look to is an asset class that has historically done a good job during periods of inflation. And this is where the arithmetic gets really interesting. It is estimated today that 0.5% of savings and investment assets in the United States is denominated in precious metals or precious metals related assets. JP Morgan Chase suggests that the same number in 1981 was in excess of 6%. But what they've documented is that the 3-decade mean was 1.5%. So if negative real interest rates were to cause the largest institutional investors in the world to be concerned about the fact that 40% of their portfolio was guaranteed to lose the money, and they began to put a little money into an asset class that historically has saved investors like them from circumstances like this, it seems to me not unlikely that the market share for precious metals would revert to the 3-decade mean. If that happened, then demand for precious metals and precious metal securities would double, triple, or quadruple. I have no idea what price level you'd reach if demand doubled, tripled, or quadrupled. But I actually suspect in my heart of hearts that I'm going to find out. The second thing that I'm doing with my own money, and this will strike everybody as really strange, is I'm staying liquid. I understand perfectly that cash is costing me mightily. The idea that I'm investing, if that's the right phrase, I'm minimizing risk in very short duration obligations means that I'm losing 6% compounded. But I believe that I have to stay highly liquid because I agree with the other panelists that we're going to see a lot of volatility. And I have learned during periods of a liquidity squeeze that if I have cash and I have courage, I can take advantage of the circumstance rather than being taken advantage of by the circumstance. Unlike most other investors, I remember 2008, 2009 very, very fondly because I went into 2008 well prepared, lots of cash, and as a consequence of the cash, I had courage. And I was able to buy things at prices that were unfathomable to me. And my suspicion is that the money that I'm losing as a consequence of negative real interest rates is an option premium. I believe that having the cash will give me both the tools and the courage to take advantage of a circumstance where a sell decision will be made by a margin clerk, not by an investor. And I hope to be on the backside of that trade. The third thing I'm doing, which is really incongruous, is for the 7th time in my career, I'm starting a new bank. I look at that. I mean, it's a really completely crazy thing for a 69-year-old retired guy to do, coming into an odd financial circumstance. But I don't talk to any investor in my network, and I talk to 68,000 of them pretty regularly, who's happy with their bank. And when I look at banks, the way they're making money right now is on the carry trade. They are buying a 10-year treasury yielding 1.7, but it's a 10-year instrument, and they're funding it in the overnight market. So they're paying 25 basis points in the overnight market and getting 150 basis point carry. That works well till it doesn't. If the overnight market seizes up or if the short-term rates go, these guys are insolvent. People always say, Rick, are you out of your mind? How can you compete with Wells Fargo? How can you compete with Bank of America? How can you compete with the Royal Bank of Canada? Truth is, I can't. And they can't compete with me either. I'm a sane, living, breathing human being. I remember, when I backed these guys in 1999, 2000 to build EverBank, everybody was saying, are you out of your mind starting a bank, especially an online bank? Yeah, probably. It ended up being a 30X for investors. We ended up building a $28 billion bank, sold it to TIAA-CREF. I think this is a wonderful time to build a bank because all the bankers that we're competing against are people that have had their expectations set in a different era. And I think that era is coming to an end. So I'm heavily invested in precious metals. I want the price to go lower because I want to buy more. I'm heavily invested in other aspects of natural resources, particularly in the oil market. The oil stocks are priced like oil's at $45 a barrel, and it's at 80. Everybody seems to believe that Ms. Thornburg is going to keep them from driving their cars next year or something like that. Ain't going to happen.
No.
So I'm heavily invested in a range of natural resources. That's a bit risky because if we do have a recession, although supply and resources will fall, demand will fall quicker. So my sort of broader resource bet, my copper bet, my nickel bet, my uranium bet, well, I'm going to be right in the long term. I might be really, really, really wrong in the short term. And against everybody else's common sense, I'm starting another bank. I don't think I can lose.
I love it. Way to win is start a bank. Everybody on the call here.
Right,
we're gonna take some questions in a minute. Before we do that, George, maybe you can just briefly talk about what you're doing, and then we'll jump into some questions here.
Yeah, like Rick, I've got a pretty large cash position, relatively speaking. I like Bitcoin long term, but I don't necessarily buy Bitcoin because of the price. I just think it's wise to have purchasing power outside of the banking system, unless Rick's buying a bank or starting a bank, and then maybe I may reconsider.
You're welcome.
Yeah.
We'll take your business, George.
As of right now, I think it's good to have some purchasing power outside of the banking system. And for Bitcoin, as far as a timing, I think I'll build my position or increase my position when I see Bitcoin stop trading based off the NASDAQ, because what that tells me is that all the weak hands and the people that have bought Bitcoin as just a pure speculation, a way to get rich, the same way they'd buy Dogecoin or Shiba Inu or whatever, all those people have sold. And then the only people that you have left are the smart people like Mark, who understand sound money, and they understand why you should actually own Bitcoin and the principles of Austrian economics and whatnot. And, once those people are the only ones left, then that's what I want to buy. And I think, again, the catalyst there will probably be when Bitcoin stops trading basically like it's the NASDAQ. Now, so that said, I really like what Rick was saying about gold. And I think maybe the gold miners right now are interesting. As far as what I do, I just set up what I call a 10-80-10 portfolio. So that's 10% in gold, which I just consider insurance. So that would be physical gold. Then 80% in things that pay you to own them. So I consider those investments. And then 10% in speculative assets, where I think the asymmetry is good. So as far as things that pay you to own them, one thing I like right now, in addition to oil, and I think the producers are paying a great dividend yield. Also, I'd encourage your viewers, if they're interested in oil, to maybe look overseas, maybe look at Russia, because right now I think Russia's getting a little cheap because of what's going on in the news, and that could be a buying opportunity. In RoboCapital's Pro, one thing Lynn Alden always talks about, and Chris McIntosh, is Luke Oil. It's a great company, low PE ratio, incredibly high dividend. I believe it's an 8% dividend yield. And I think they've gone down a little bit more than, or they're even cheaper than a lot of the other oil producers, just because of that friction that we see in the news between the United States and Russia. Sberbank is actually a bank in Russia that is paying a good dividend yield as well. So I'd encourage people to kind of get outside the box. But one thing I really like is coal. And I think coal could be the tobacco of the 2020s and 2030s. From the standpoint, if you remember tobacco back in the mid 1990s, it was persona non grata. And if you look at its performance since then, it's one of the best performers in the stock market when you reinvest dividends. And why is that? Because basically the government came after them and they created a monopoly. So it was absolutely impossible to get into the tobacco business unless you were already there. So the players that existed in the 1990s, these mega corporations, the government effectively built a moat around them. And I think you see that same type of language towards coal right now, or that same type of view towards coal that people had towards tobacco, that, oh, no one's going to smoke, demand's going to plummet, blah, blah, blah. You hear the same thing about coal. And sure, demand might go down, but I think that supply will go down a lot faster. And if that happens, then prices will go up. And you've got to look at China, emerging markets. I mean, yes, China's probably going through a recession right now because of what's happening with the real estate market. But eventually they're going to build again. If we do a Green New Deal here, that requires a lot of steel, that requires a lot of coal. So I think that's something that's outside of the box that is interesting. I would fade ESG because, and again, that's going back to what Rick was saying, that, sure, it's we all want clean air. We all want to save the planet. But at the end of the day, if people want us to just switch right over to wind and solar, that's going to kill about 3 billion people in the world. And I don't think that, I think what's going to happen is like Europe, you're going to see the prices of energy increase substantially. Then they're going to call time out and say, whoa, wait a minute here. Let's go ahead and throw nuclear into the definition or the category of green energy. You saw them do that in Europe lately. So sure, there's some issues with Kazakhstan and whatnot, but I think those are just temporary. And sure, there could be more supply come online. Rick, I'm sure, can talk about this far better than I can, but I know there was one of the big uranium outfits that basically kind of shut down in 2018. And a lot of people are saying that could come back online if prices get high enough, and that increases the supply substantially. But from what I've read, sure, that may have some, temporary effects on the price, but longer term, it goes back to what Rick told me the very first time that I interviewed him, and what he reiterated here tonight, and that you're really asking a when question instead of an if question. And I think that pertains to uranium, oil, potentially coal as well. And if you can buy some of these producers that pay a great dividend yield, then you can get paid to actually wait. And one of the things I love about having 80% of your portfolio pay to own them or pay to own it, and this goes with positive cash flowing real estate too, especially if you can get long-term fixed rate mortgages. You've got a big cushion right there, because let's say that your equity goes down, or let's say that the price of Luke Oil goes down. You don't care because you're not selling. The only thing you care about is getting paid that positive cash flow. And if you've got a significant portion of your portfolio allocated to that positive cash flow, even if you do lose purchasing power on your cash position, you've got cash coming in to subsidize it, right? And so that's kind of what I'm doing with my own money. And it's not investment advice, but hopefully people can get some value out of it.
Thanks, George. We're taking some questions now. A question came in. If you have a question, just go ahead and type it in the chat. But of the 80%, somebody's asking, is that real estate? Is that companies? Like, how do you break that? Just assets that pay you to hold them. So is it all pretty much equities, businesses, and real estate?
Yeah, I mean, yes, to answer your question, and how I would divide that up, it depends on what you're an expert in. So Bronson, you would probably want a higher percentage of that 80% in multifamily properties, because that's your business. You know that like the back of your hand. And although we are in a very hot market, you and like Kenny McElroy would be another example of that, or Jason Hartman, you guys are so good at this. You're going to take advantage of every opportunity because you're an expert. Now, if I was, Rick is obviously an expert in precious metals in the commodity space. So, he might want to have a larger percentage of that 80 allocated to what he's an expert in.
Yeah, that's great. Thanks for that. Question here from Sandra's, how do we use your bank, Rick? Is there a name, or is it started yet, or how do we get involved with that? You already got some customers here for you.
Free checking.
If we assume that the comptroller of currency isn't listening to this interview and deigns to give me a bank charter, we hope we'll have a bank charter in June or July. The name of the bank will be Battle Bank. You can go to battlebank.com. That exists now. And we'd love to talk to you. Among the things that we have done and will do again is lending against people's physical precious metals holding. We know physical precious metals holders as people. We're happy with the collateral. We've done precious metals lending for many years. So I'd love anybody who cares about the bank, either as a depositor. We aim to be in the top decile of deposit interest rates in the market, or as a borrower, as long as we understand the collateral and we understand you. We'd love to have a discussion. It'll be called battlebank.com. My hope is that it'll be chartered in June or July. So
awesome.
I like my interest.
I know the name is awesome. We'll fight for your business or something. It'll
that's
be some
it.
Slogan
you
there.
got it. You got it.
Have George sing a jingle to that one or something.
All true. We've done it before.
Exactly. A couple questions here about coal. So I'm not sure who wants to handle this, but how do you invest in coal? Like an example, or somebody's asking about the Van Eck closed the KOL ETF fund. So there was a coal ETF. So maybe I'm not sure who wants to handle that. Uh-huh.
Rick can probably speak to that better than I can.
The fact that they closed the ETF is really good news. It means that coal is deeply out of favor. Many people don't know that the third best performing commodity asset class in 2021 was coal, allegedly a dead asset class. Many people don't know either that the highest demand year that coal has ever enjoyed was 2021, a dead asset class. You need to do some research, because the most important producers of coal are in a situation where coal isn't very important to them, which is to say very large multi-commodity mining companies are the largest and lowest cost coal producers. It's tough to find a pure play in coal. There are some, Peabody, Arch, Colonial, there's a range of them. You need to understand that if you buy them, you're buying the second-tier companies. You're buying second-tier companies at probably a 50% discount to the net asset value of their future cash flows at today's commodity prices, which is to say they're stupidly cheap. And they're also fairly well-mannered in the sense that they're generating tremendous free cash flows, and they're giving that free cash flow back to their owners, which I think is a very good thing. One example of just how cheap these things are and how good George's instincts are Glencore, a major multinational company, mining company, bought one of their partners out of a very large coal mine, probably 30 years reserves, and they paid 1.5 times free cash flow for half the mine. In other words, they're getting what, a 45% earnings yield on the purchase. And they're getting a 45-year earnings yield on a mine that's making about $1 million a day. It's not an insignificant asset. That'll tell you just how out of favor coal is. But you'll need to do your own research there.
Right. We'll take maybe one or two more questions here. Let's see. Maybe this will go to Mark. What's the best crypto? Maybe he talks about crypto or Bitcoin ownership. Do you use a certain platform, or is there something that has low counterparty risk? Do you do cold storage? How do you actually own your crypto or your Bitcoin?
Well, again, if we're just talking about Bitcoin, I look at it kind of the way Rick was talking about gold, in a sense where, you know, if the price goes down, we buy more. And the reason why we do that is because we're thinking long term, and it's not just an investment, it's a savings, right? I'm sure probably Rick thinks about gold that way too. It's like, it's not about investing money, it's about saving money that way. And if you want to save it, then you want to keep it protected, obviously. And then depending on the amount of money that you have, depends on the level of security that you need to apply to that. So no different than any other asset. And so for most people, I would always recommend to get that off of the exchange. That means wherever you bought it, take it off and take custody of it yourself. That's the key benefit of one of the key benefits of having an asset like Bitcoin is you can custody it yourself. And so pull it into a hardware wallet. You can use one like Trezor or Ledger. They're about $75, $100. You can buy one. It stores your private key. If you have more than that, more money, and you want to secure it better, then you can do a multi-signature setup where you have like 3 keys, and then it takes like 2 of the 3 keys to sign a transaction. And that's probably the better way to do that. But definitely just have that longer term viewpoint of it. If you put it into that cold storage, meaning it's offline, it's in this multi-sig setup, it's inconvenient, and it's for long term. If it's just cryptocurrencies and you want to trade them like penny stocks, then just keep it on the exchange, trade away, keep a small amount that you're not afraid to lose. I personally had more than 7 figures disappear off of an exchange. And so you don't want that to happen to you. So
Wow.
Lock it away in cold storage.
That makes sense. Makes a lot of sense. Okay, so this will be I guess this will be our last question, and then we'll just I do want to ask you guys one specific question, because I think you guys are in this all the time. There's a high level of analytics. Even some of the discussion, I think, goes over my head or a lot of people's head when George starts rambling all these things. I'm like, I think I got it. I think I got what George is saying. But what are some ways, besides, watching your YouTube or watching, different things that you guys are doing, what are some, do you have like maybe a book recommendation, or do you have some sort of like resource that someone can say, hey, I'm going to read this because George, Mark, or Rick said to read this? Is there something people should be looking at now that will help educate them for the long term going forward?
I would say, I think books are great to get good perspective. I've learned a lot through reading history. And so this type of period right now, so like When Money Dies is a great book that really documents what happened in Weimar Republic. And I think when you get that perspective of how people thought through that, how they thought that gold was at an all-time high, real estate was an all-time high, they should sell now. And then they ended up with worthless fiat money and lost all their assets. And so I think some books like that give you some good perspective. As far as like learning how to invest or how to navigate it, I don't know if the books are really up to date for that, other than getting that perspective. On top of that, I think I've learned a lot through buying and subscribing to investment newsletters, and it's really the play-by-play, playing along. I know George devours the news every day, as do I. I'm sure Rick does as well. Seeing what's going on, seeing how it's happening, reacting. So I would say a couple books like When Money Dies gives you that historical narrative. And then there's a new one that I just started reading, Lords of Easy Finance, which just came out, which really documents kind of more 2008 to now, which is some good perspective. And then kind of the play-by-play stuff.
Awesome. Thanks for that. Yeah, I'm just finishing When Money Dies. So it's a good recommend. It's a great book. George, what about you?
Well, I totally agree with Mark. I think you got to, especially, we're talking about financial freedom here, or bettering your financial position. But in today's day and age, I think you've got to think about personal freedom as well. And to really understand what's happening around the world around us, you have to study history, and not just economic history, but history in general. So I would start there. And then another thing that I would do as far as a book about investing specifically is I would read the Market Wizards books. And the first one I believe came out in the late 80s or early 90s. And it had Jim Rogers in there, who was one of my favorites. But and it's not like you want to invest just like Jim Rogers or just like Stan Druckenmiller or Ed Thorpe or one of the legends. But when you read those stories and you read those interviews, you can understand their mindset. And that makes all the difference in the world. What you start to realize is that being a good investor over the long run is really all about risk management. That's really what it's about. It's managing your downside. And so that's one of the takeaways. But if you can take away, even 3 or 4 or 5 of those golden nuggets and apply them to your own investing, then that will give you a mathematical edge. And I think so many people that invest right now, I see them in the comments of my YouTube videos. I talk to them at my live events or, when I'm speaking publicly, and they don't have an edge. In fact, they don't even really, they're not even cognizant of having an edge. And they are just trying to figure out, is the price of XYZ going to go up or down? Well, that's not an edge. Right. If that's all you're trying to do, you're competing against, high frequency traders. You're competing against these hedge fund guys like Stevie Cohen and in Druckenmiller himself. You're not going to win that battle. And if you don't have a mathematical edge, then it's just like playing a slot machine in a casino that you might win, you might have an up year, but if you keep doing that over the long run, you're going to lose. You're going to go bust. So with those Market Wizards books, those are the ones that taught me about how important not only probabilities were, but actually having an edge and therefore having a mathematical edge. So the longer you do what you're doing, the greater probability that you come out a winner. And so that I'd probably start with those. And among then all the podcasts that we all listen to, Macro Voices as an example, Real Vision, any of the podcasts that Mark does, or I think your listeners are probably familiar with those.
Right. Thanks for that, George.
I love what George said. I just want to hit on that one more time about the edge. And so I heard someone asking, like, what does George do with the 80%? And George said, well, it depends, right? Like, what are you into? What do you know about? And people don't like to hear that answer. It depends, but it does depend. Like, where is your edge? And if you don't have one, then you need to get one. And you get one by finding where you're interested. So if I'm really into energy, then I can learn all about energy and maybe I can develop an edge there, or real estate if I'm really into real estate, et cetera. And so you don't have to be in every market all the time. Find out where you have that interest. That old cliche, if you love what you do, you never work kind of a thing. That means if you love what you're doing, it's not work. And so if you love that asset class, if you love that sector of the industry, you'll spend enough time there, and you have to. Otherwise, you're going against the Stanley Druckenmillers, and you can't go against them with half your ability. You need all of it.
Yeah, it's like that saying, or if people are wondering on the live stream right now, if they have an edge, I can guarantee you don't. It's like that saying, if you're wondering who the sucker is at the poker table, it's you.
That's awesome. No, it's so important. Yeah. If you don't have an edge, you can get an edge. And that's, obviously we all have different edges if we approach things differently, and that's what's, important. So Rick, talk to us about how, with your wisdom and experience, what advice would you give to people as far as educating themselves today?
Well, I, in fact, developed an edge in my 20s, and mercifully, I've stayed in the same business all that time, which is probably how I've come out okay. In terms of more general discussion, the first thing I do is have people re-listen to what George just said about an edge. But in terms of general investing knowledge, I love books. I would start with Economics in One Lesson, the old classic, to learn about how the economy actually works, as opposed to the way that you're taught that it works. It's a simple book. It doesn't take much skill to read it, and you learn a lot from it. The foundational investment book, from my viewpoint, is The Intelligent Investor by Ben Graham. Almost 100 years old. It's older than me. Nothing really has changed since he wrote that book. It's the best investment book ever written relative to the effort required to read it, which is low. If you read it, don't just buy it, read it. if you read it, the best investment book ever written, irrespective of qualification, is Securities Analysis, also by Ben Graham. If you read that book, invest for the long term, and employ the discipline in that book, you will, not can, you will get rich. It's just that it's very difficult to invest in the time frames that they talk about and not be carried away by fads. The most impactful book in my life and in my career, the best book I've ever read, and people will hate me for this if they start it, is Human Action by von Mises, because the economy is really the actions of a whole bunch of individuals coming in contact and talking about the motivation behind individuals, and hence the motivations behind groups, is something that allows you to understand every aspect of society, including economics and including investment. So one more time, economics in one lesson, The Intelligent Investor, Securities Analysis, and then the ultimate sleeping pill, Human Action.
I love it. Gentlemen, thank you so much. I really appreciate the input. Each of you are obviously leaders in each of your fields. I just really appreciate the opportunity to do this with you. If you do have interest in reaching out, hearing, I mean, they're all doing fantastic stuff. I know George and Mark have inner circle events. They have live events. They've got trainings. I know Rick he's kind of on tour doing a lot of speaking. So follow these guys on YouTube, get in touch with them. I just put a little note in the chat for the next event on March 2nd. If you're watching this on a replay, we typically do multifamily events 1 month, and then we do inflation events another month. So you can check out that there. Again, because of time, we're going to go ahead and wrap up. I just want to say thank you to each of you, as well as to our audience. The best investment you can really make is in your own education. So thank you, everyone, both for being here, for taking the time, taking the hour or so to be on this webinar, as well as watching this video, as well as our panelists. So thanks so much, guys. We'll look forward to hopefully having you back again another time soon.
Thank you.
Thanks for having me.
Thanks, guys.